There are two dire warnings on Britain's ailing economy today. The International Monetary Fund believes the slump here will be even worse than it had predicted. It says that Britain's recession will be deeper than any other advanced economy. And the respected Institute for Fiscal Studies said the real cost of the credit crunch is tens of billions of pounds higher than the government's estimate. Well, Richard Scott is here with the details. Richard.
Thanks, Fiona. So, the UK recession is expected to be the worst of all the advanced economies. That's according to the International Monetary Fund, which says the UK economy will shrink by 2.8% this year.
The UK is a financial centre, and it did very well when financial centres did well, and it's going to do very poorly when financial centres are in trouble.
A shrinking economy is bad news for government finances. Another report today says that even if everything goes as the Treasury hopes, it'll still be the 2030s before public debt returns to pre-crisis levels. But the report also thinks the government is being too optimistic, and really, to meet that target, it'll need to raise an extra £20 billion a year. Under its forecast, public debt in 5 years' time, compared with last year, will be increased by the equivalent of £12,000 for every family in the UK. So, if the report is right, how could the government raise this extra cash? One way to plug the funding gap is tax increases. Today's report from the Institute for Fiscal Studies says removing the VAT exemption on things like children's clothes and food, for example, would raise £10 billion a year, half the extra money needed. But there are other possibilities too.
The Treasury was looking for money at the pre-budget report. They were focusing on things like national insurance rates and also increasing income tax for very high earners, people on 100,000 plus. And we also know that they considered raising the rate of VAT once the temporary cut is over to 18.5% rather than 17.5%. So you might think that they would look again at those sorts of taxes.
Another option is public spending cuts. The IFS thinks total government spending may have to be frozen in real terms. If high priorities like health or education still see their budgets rise, others will have to be cut. Moves like linking the state pension to earnings could also be postponed. So would people prefer spending cuts or tax rises? We asked people in Cardiff and Birmingham what they thought.
To get the country out of recession, the quickest way to do it and to get more money into the government coffers is by us coughing up.
Cuts in public spending, not necessarily cuts in public services, more efficient employment and cash in public services. I think that's what's needed.
It's not really much of a choice, is it?
Today's report about the state of the government finances provoked a furious exchange in Prime Minister's questions.
And today we're told the debt he's building up will take a generation to pay off. What we've had from this Prime Minister is denial about the past, continuing today, failure in the present, and debt for the future. Shouldn't those be the death throes of a failed premiership?
He mentioned the Institute of Fiscal Studies. They also said, in current circumstances, the cost of doing nothing is larger than the cost of acting. That is the rebuttal to the Conservative policy of doing nothing.
There was some good news, though, in today's report. It argues that measures like the VAT cut will mean we avoid a deep and prolonged recession. And it's less gloomy than the IMF, expecting the UK economy to shrink by just 1.3% this year. Fiona.
Thanks very much, Richard. Well, despite those gloomy economic forecasts, there was some good news on jobs today.